Have you ever wondered why interest rates can make or break an economy? Picture this: between 2008 and 2015, the US Federal Reserve slashed interest rates to nearly zero in response to the financial crisis, pumping trillions into the economy through quantitative easing. This move wasn't just a random decision, it was a key part of monetary policy designed to save the economy from collapse. But why does this matter to you? Well, monetary policy affects everything, from the price you pay for groceries to the interest on your mortgage. In fact, when inflation hit a 40-year high of 9.1% in 2022, central banks around the world quickly raised interest rates to control rising prices. These changes influence not just billion-dollar corporations, but also your daily financial decisions. Welcome to Satoshi Finance, where we break down complex finance topics to educate and empower you on your journey to financial freedom. In this video, we're going to dive deep into the role of monetary policy and how it shapes the economy. Whether it's through controlling inflation, boosting employment, or managing economic crises, understanding monetary policy is key to understanding how economies thrive or fail. Stick around, and let's explore how these decisions by central banks impact all of us. Monetary policy refers to the actions taken by a country's central bank, such as the Federal Reserve in the US, to regulate the supply of money and control interest rates. These actions are designed to influence overall economic activity, including growth, inflation, and employment. By managing the flow of money in the economy, central banks can encourage spending or saving, impacting consumer behavior and business investment. The key objective is to maintain economic stability by keeping inflation at manageable levels and ensuring that the economy operates close to its full potential. There are two primary types of monetary policy: expansionary and contractionary. Expansionary monetary policy is used when a central bank wants to stimulate the economy, usually during periods of slow growth or high unemployment. It involves lowering interest rates and increasing the money supply to encourage borrowing and spending. On the other hand, contractionary monetary policy is employed to combat inflation. By raising interest rates and reducing the money supply, central banks aim to decrease spending and borrowing, which helps prevent the economy from overheating. Both types are essential tools for maintaining balance and ensuring long-term economic health. The primary objective of monetary policy is to control inflation and stabilize prices. Inflation occurs when prices rise too quickly, eroding the purchasing power of money and leading to uncertainty in the economy. Central banks aim to keep inflation at a stable, low rate, typically around 2% in many developed economies, to ensure that prices remain predictable for consumers and businesses. By adjusting interest rates and managing the money supply, central banks can influence inflationary pressures and help maintain price stability, which is essential for long-term economic confidence. Another key goal of monetary policy is to promote maximum employment. A healthy economy should ideally have low unemployment, where most people who want to work can find jobs. When central banks implement policies to stimulate economic growth, such as lowering interest rates, they make it easier for businesses to invest and expand, ultimately leading to more job creation. In addition, monetary policy seeks to moderate long-term interest rates. Keeping these rates stable helps manage borrowing costs for businesses and consumers over time, encouraging steady investment and growth while reducing the risk of economic volatility. By balancing these three objectives, central banks can foster a more stable and prosperous economy. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Central banks use several tools to implement monetary policy, with one of the most well-known being interest rate adjustments. The federal funds rate, for instance, is the interest rate at which banks lend to each other overnight. By raising or lowering this rate, the central bank can influence the cost of borrowing throughout the economy. When interest rates are lowered, borrowing becomes cheaper, which encourages businesses and consumers to take loans, spurring economic activity. Conversely, raising interest rates makes borrowing more expensive, which can slow down inflation and prevent the economy from overheating. Another key tool is open market operations, where the central bank buys or sells government securities, such as bonds, to control the money supply. When the central bank buys securities, it injects money into the banking system, increasing liquidity and encouraging lending. Selling securities has the opposite effect, reducing the money supply and tightening monetary conditions. Reserve requirements are also used, which dictate how much money banks must hold in reserve and cannot lend out. By adjusting these requirements, central banks can influence the amount of money available for lending. Quantitative easing, QE, is a more modern tool, typically used in times of severe economic downturns. Through QE, the central bank buys a large amount of longer-term securities to increase the money supply and lower long-term interest rates, aiming to stimulate borrowing and investment when traditional interest rate adjustments may not be enough. QE played a crucial role during the 2008 financial crisis and the COVID-19 pandemic to boost liquidity in struggling economies. Lowering interest rates is a common tool used by central banks to stimulate economic growth, especially during periods of recession or slow growth. When interest rates are reduced, borrowing becomes cheaper for both businesses and consumers. This encourages businesses to take out loans to invest in new projects, expand operations, or hire more employees, which can lead to economic expansion. Similarly, consumers are more likely to borrow money for large purchases such as homes and cars, which boosts demand in the economy. This increase in spending and investment can help drive growth, reduce unemployment, and improve overall economic conditions. On the other hand, raising interest rates is a strategy used to control inflation when the economy is growing too quickly. By making borrowing more expensive, higher interest rates discourage spending and investment. Businesses may delay expansion plans, and consumers may cut back on big-ticket purchases, leading to a slowdown in economic activity. This reduced demand can help keep prices from rising too quickly, preventing the economy from overheating. Interest rate changes also affect unemployment. When rates are low, businesses tend to expand, leading to more job creation, whereas higher rates can slow down hiring and potentially increase unemployment as businesses tighten their budgets. Ultimately, interest rate adjustments are a key way monetary policy influences the balance between growth, inflation, and employment in the economy. One of the main challenges of monetary policy is the time lag between when a policy is implemented and when its effects are felt in the economy. Adjusting interest rates or altering the money supply does not produce immediate results. It can take months or even years for the full impact of these changes to filter through the economy. For instance, if a central bank lowers interest rates to stimulate growth, businesses and consumers may not immediately respond by borrowing and spending more. This delay can make it difficult for policymakers to precisely time their interventions, sometimes leading to overcorrection or undercorrection of economic conditions. Another challenge is the risk of inflation or deflation. While monetary policy aims to keep inflation under control, missteps can lead to unintended consequences. If interest rates are kept too low for too long, inflation can spiral out of control, eroding purchasing power and destabilizing the economy. On the other hand, overly aggressive interest rate hikes can lead to deflation, where prices fall and economic activity slows down significantly. Deflation can be especially harmful, as it discourages spending and investment, leading to a vicious cycle of economic stagnation. Global influences also pose limitations to monetary policy. In an interconnected world, economic events in other countries can undermine the effectiveness of domestic policy actions. For example, a global recession or supply chain disruptions can limit the impact of domestic interest rate adjustments, as external factors drive inflation or economic conditions. Additionally, fluctuations in global capital flows and currency exchange rates can interfere with a central bank's ability to stabilize its own economy. This makes it increasingly difficult for central banks to achieve their objectives solely through domestic monetary policy. Monetary policy played a crucial role during the 2008 financial crisis, as central banks around the world took unprecedented actions to stabilize their economies. In the US, the Federal Reserve slashed interest rates to nearly zero in an effort to boost lending and stimulate growth. Additionally, the Fed implemented quantitative easing, QE, purchasing large quantities of government securities to inject liquidity into the financial system. These actions helped to prevent a deeper economic collapse by encouraging businesses to invest and consumers to spend, while also providing support to financial institutions that were struggling during the crisis. Similarly, during the COVID-19 pandemic, central banks once again turned to aggressive monetary policy measures to combat the economic fallout. With businesses shutting down and unemployment skyrocketing, central banks cut interest rates to historic lows and expanded QE programs to keep the financial system functioning. In the US, the Federal Reserve also introduced emergency lending facilities to ensure that credit continued to flow to households, businesses, and local governments. These swift actions were instrumental in preventing a more severe economic downturn and helping the global economy recover more quickly. These examples highlight the power of monetary policy in addressing major economic disruptions, but they also underscore the need for careful management to avoid long-term risks like inflation. In conclusion, effective monetary policy is essential for maintaining a stable and thriving economy. By carefully managing the money supply and adjusting interest rates, central banks can control inflation, promote employment, and moderate long-term interest rates. These actions help to balance economic growth, preventing both runaway inflation and deflation. The ability to respond to economic crises, as seen during the 2008 financial crisis and the COVID-19 pandemic, demonstrates the crucial role monetary policy plays in safeguarding the overall health of the economy. Monetary policy doesn't just influence abstract economic indicators, it directly impacts everyday life. The interest rates set by central banks affect the cost of loans for everything from homes to cars, making it easier or harder for people to borrow money. It also influences job opportunities as businesses respond to economic conditions by hiring or cutting back. Even the prices we pay at the grocery store or gas station are shaped by central bank decisions on inflation. Understanding how monetary policy works helps us see how closely tied it is to the financial decisions we all make on a daily basis. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.